You are being lied to by a number, not a fake number, not a manipulated number. A completely real, accurately calculated, publicly available number that is nevertheless designed, whether intentionally or not, to make you feel wealthy before it makes you poor. That number is your dividend yield. And the bigger it looks on your screen right now, the more urgently I need you to stay with me for the next 8 minutes. Because I put $100,000 into 5 different dividend stocks ranked from the safest yield to the most dangerous. And what happened to that money is going to permanently change how you read a yield percentage for the rest of your investing life. Before I walk you through each position, I need to plant one idea in your head and leave it there the entire time. A yield is not a reward. A yield is a worry meter. Every single percentage point above what the market considers normal is the market. Not me, not an analyst, not a financial media outlet. The actual aggregate intelligence of millions of participants simultaneously pricing in the probability that the payment underneath that number is fragile. The bigger the yield, the louder that warning is. Most income investors look at a high yield and feel excited. What they should feel is curious. Curious about what everyone else knows that they do not. The first position is Realty Income, ticker O, yielding 5.4%. The smallest number on the entire list. And I want to be honest, when I first looked at it sitting next to the other 5.4% felt almost embarrassing. It felt like showing up to a high-stakes poker game with pocket change. But here is what that 5.4% actually represents. 32 consecutive years of dividend increases. Not maintained, increased. Every single year for 3 decades, through recessions, through rate cycles, through every macro environment that has destroyed less disciplined income businesses around it. The payout ratio sits at roughly 75%, high enough to signal commitment, low enough to leave a real buffer underneath the payment. That buffer is the entire reason the yield stays at 5.4 instead of 8. Safety has a price, and this is it. The $100,000 in Realty Income paid $5,400 in dividends over the year, about $450 a month, while the share price crept up just under 5%, adding another $4,600. Total return, $110,000. A quiet, boring, unexciting 10%. The kind of 10% that will still be arriving, uninterrupted, a decade from now. While the stocks above it on this list are issuing dividend cut announcements. The second position paid nearly double. Main Street Capital, ticker MAIN, yielding 8.59%. And this is where the first trap closes. When a yield nearly doubles, the brain registers upgrade. More income, better position, simple arithmetic. But the distinction between Realty Income and Main Street is not just a number, it is a structural shift in what you actually own. Realty Income is a landlord. Main Street is a lender. It provides capital to mid-sized businesses that cannot access traditional bank financing. Lenders get paid before landlords, until they do not, until one of those mid-sized borrowers hits a rough quarter and misses a payment. The risk does not show up in the yield until it is too late, which is precisely why 1 in every 10 main shares is currently sold short. Meaning 10% of the float represents investors who have done the analysis and placed a financial bet that the price is going lower. The dividend arrived exactly as promised. $8,590 over the year, $716 a month. But the share price fell 13%, erasing $12,900 of the principal. Net result, the $100,000 became $95,700. Every check arrived on schedule, and the position still lost money. The yield did not lie. It warned. The third position is the one that is going to make you question everything I just said. A AGNC investment, yielding 13.87%. And here is where this experiment gets genuinely uncomfortable. AGNC pays out 96 cents of every dollar it earns, leaving almost nothing retained for growth or protection. It has never raised its dividend. It has cut it. The share price has lost roughly half its value over 5 years. And the company recently authorized up to $2 billion in new share issuance to fund continued operations, which means the shares you own are being quietly diluted to keep the checks flowing. Every single fundamental signal is pointing in the same direction. And yet, the $100,000 in AGNC returned $13,870 in dividend income, and the share price moved up 12%, adding another $12,000. Total return, $126,000, 26%. The best single-year result of every position on this list. The most dangerous stock on paper produced the best outcome. This is the specific mechanism that makes high-yield chasing so destructive at scale. It occasionally rewards the behavior spectacularly, which is precisely what makes the next bet feel justified. The fourth position is PDI, the PIMCO Dynamic Income Fund, yielding 16.19%. And PDI has a hidden entry cost most investors miss entirely. The assets inside the fund are worth $15.80 per share. It trades at $16.34. That 3.42% premium means you are paying more than the fund is actually worth the moment you buy it. Then there is the annual fee, 4.12%, deducted before a single dollar of dividend reaches you, in a world where index funds charge fractions of that. The year went like this. The share price fell 12%, taking $12,300 off the principal. But the dividend was $16,190, roughly $1,349 a month, and it was real income backed by real underlying assets. Real enough to not just absorb the price decline, but push past it. The $100,000 ended at approximately $104,000, a modest win, rescued entirely by the size and authenticity of the payout. Remember this distinction because the final position is going to destroy it. MSTY, the Yield Max MSTR Option Income ETF, 66% yield. On $100,000, that is $65,750 annually, $5,479 arriving every single month. This is the number that rewires the brain. This is the number that makes every piece of analysis above feel overly cautious. Until you ask the one question that changes everything: where does that income actually come from? MSTY generates approximately 1.5% in real income from its underlying activity. It pays out 65.75. The remaining 64 percentage points come from one source: you. The most recent distribution was 97% return of capital, a technical classification that means the fund is taking your own principal, repackaging it as a dividend payment, and returning it to you. While charging fees on the money it is giving back, it is mathematically equivalent to withdrawing cash from your savings account and calling it investment income. A year ago, one share of MSTY cost $115. Today it costs $15. The price did not dip. It collapsed, down 85%, vaporizing $84,700 of the $100,000. The dividend still paid out $40,900 in cash over the year, but $40,900 cannot rescue an $84,700 principal loss. The $100,000 ended at $56,000, and the income this fund advertised for a single year is now larger than the total value of the account it was supposed to generate that income from. Here is what 5 simultaneous experiments in the same year revealed about the relationship between yield and safety. The 5.4% payer grew the money. The 8.59% payer shrank it despite paying every dividend. The 13.87% payer had the best year while every underlying metric deteriorated. The 16.19% payer rescued a losing price year with authentic income. And the 66% payer returned your own money to you in labeled envelopes while the account it was draining collapsed beneath the surface. Bigger yield did not mean better outcome. It meant the market was pricing in a risk that eventually materialized, except in AGNC's case, where the risk simply had not bitten yet. The pattern underneath all 5 results is the same pattern. A yield is not a reward for patience. It is not a signal of generosity from the companies paying it. It is a pricing mechanism, the market's way of charging you an implicit risk premium for the probability that the payment is less durable than it appears. At 5%, that probability is low. At 66%, the payment is not income at all. It is a scheduled return of your own capital dressed in dividend language, arriving in your account on a predictable schedule while the underlying position loses value faster than the envelopes can arrive. The number you chase at the top of the yield ladder is not the number that builds the portfolio you actually need. The number that builds it is the one that is still arriving, unchanged, a decade from now. While the names above it on the ladder are still explaining to their shareholders why the check had to be cut.